Before sunrise on September 15, 2008, employees at Lehman Brothers received devastating news. The company was filing for bankruptcy. It was the largest bankruptcy filing in American history at the time. More than $600 billion in assets were involved. Employees walked out of their offices carrying personal belongings in cardboard boxes. Across the globe, investors panicked, and markets entered a terrifying freefall. A foundational pillar of American finance had shattered. As the market crash wiped out billions in value within hours, the perceived stability of the entire financial system vanished along with it. Lehman Brothers had survived for 158 years. The firm successfully navigated the American Civil War, multiple financial panics, and the crushing poverty of the Great Depression. If an institution is strong enough to survive a century and a half of global ruin, what kind of hidden vulnerability destroys it overnight? The answer starts in 1844. Three immigrant brothers, Henry, Emmanuel, and Mayer Lehman, arrived in Alabama. They quickly noticed that local farmers often paid for their supplies in cotton. Recognizing the rising value of this raw material, the brothers pivoted. They stopped selling dry goods and started trading cotton. As the United States industrialized, the firm moved to New York. They financed physical growth, helping to build railroads, manufacturing plants, and large retail businesses. Their early survival relied on calculated adaptability. They recognized exactly what the physical economy needed to grow, and they adapted to provide it. By the early 2000s, that physical connection to the economy was gone. On Wall Street, the culture was hyper-competitive, and the country was becoming dangerously obsessed with the housing market. Lehman aggressively bought mortgage-backed securities, bundling thousands of home loans into one massive asset. To maximize returns, they used leverage, relying heavily on borrowed debt. This inflates profits during a boom, but creates massive vulnerability. If housing prices fall, the losses are enormous. The brothers who traded physical cotton in Alabama were gone. The modern firm was taking highly complicated gambles on abstract math. The very instinct that built the company, expanding into new markets to capture profit, had mutated. It was now a debt-fueled trap that hollowed out the firm's structural integrity. At the center of this strategy was CEO Richard Fuld. Known across the industry as the Gorilla, he was fiercely competitive, demanding, and unyielding. Under his leadership, profits soared and bonuses grew massively. The wealth created a dangerous echo chamber on the trading floors, where everyone felt invincible. Outside analysts warned that the housing market was overheating. Data showed that many homeowners couldn't actually afford their mortgages. Yet leadership ignored the warnings and pushed for even more growth. The prestige of a century and a half of survival, combined with immense financial success, blinded some of the sharpest minds in finance. They were manufacturing their own destruction, and they refused to look at the math. Eventually, the math caught up. Housing prices finally stopped rising. Homeowners started missing their payments and defaulting on their loans. Almost immediately, the bundles of mortgages sitting on Lehman's balance sheet lost their value. The assets they held were suddenly toxic. This is where the extreme leverage proved fatal. As the value of their assets shrank, the immense weight of the debt they had borrowed crushed the company's actual cash reserves. Over a frantic weekend in September, government officials and banking executives held emergency meetings. No buyer stepped forward to absorb the massive losses, and the government refused to authorize a rescue. The math was ruinous, but the ultimate killer was the complete evaporation of trust. Once competitors saw the internal rot, no one wanted to do business with them. The 158-year-old machine stopped. The shockwave hit immediately. Banks stopped lending to one another, credit markets froze solid, and businesses everywhere struggled to operate, igniting a global financial crisis. While the firm had survived a century of external catastrophes, it ultimately succumbed to the internal mechanics of its own balance sheet. The decision to prioritize high-leverage debt over the physical industry that built its legacy created a vulnerability that the firm could no longer sustain. It stands as a permanent warning. No institution is too historic to fail. Risk never truly disappears, and history ruthlessly repeats itself when we ignore its lessons.